Hello, this is Penny with Beacon Community Credit Union, and I am going to do the third portion of our financial wellness training for the Fear to Ovec preschool parents. And today we're going to talk about borrowing and credit. So in this workshop, we're going to talk about what is credit and how do we use credit. It's all about how we pay our bills, how we handle our finances, what we are doing to maintain our credit along the years as we go along. And we're going to talk about how important it is to make sure that we monitor our credit and that we continually look at it just to ensure there's nothing on there that we're not aware of. So credit is basically a way to buy things when you don't have to pay for things all at once. So examples are like a car. A car is expensive. You can't go pay cash for a car. You're buying a home. Maybe you're buying another item that's too expensive just to pay cash for it. So those are typically bought on credit. And when you buy something on credit, it really looks at your credit report to determine how you've paid your bills. Do you pay on time? How much credit do you have? How many bills do you owe on? And can you afford to make a big loan or a big purchase on something? And really, your credit score also determines what kind of interest rate that you'll get on a loan and whether the creditor is going to approve you for that loan or not. Types of credit. So we have a couple types of loan. There's installment loans and there's revolving credit loans. So an installment loan is a loan that you take out and you get a lump sum up front and then you make payments over it over a certain amount of time to pay that loan back. So like I said, this is more of typically bigger priced items like your car, a mortgage, something that's too much money to buy all at once. And those are called secured loans. So there's something secured that loan. So for example, a car loan, if you have a loan on a car and you don't make your payments, the creditor can come and take the car. That's the security for the loan. So even though you have the car, you're driving the car, you're using the car, it is still in a way owned by the bank or credit union or financial institution who gave you a loan until you pay them back in full. And there's a lot of different factors in how much you're going to pay back on an installment loan. The interest rate is one factor. The repayment term, how long you stretch out that loan, and whether or not you make extra payments on a loan during the course of that loan. Here's an example that we can look at for a student loan. Let's say that you had borrowed a student loan, it's at 6.9%. If you pay that loan back in 5 years, you're going to have a higher payment. You're going to pay $987 a month. You're going to pay back $9,262 in interest over that 5 years. Now, if you decide, you know what, that $987 is too much, I'm going to take 10 years to pay this loan back. Well, if you do a 10-year loan on $50,000 at 6.9%, then your payment drops to $577 a month. But look at that interest. You're going to be paying about $10,000 more in interest over the life of that loan. Let's take it out longer. Let's go to a 20-year loan. If you borrowed $50,000 at 6.9% for 20 years, your payment's going to drop to only $384 a month, which sounds wonderful, but look at your interest now. You're paying $42,000 in interest over that 20-year loan. So shorter term loans will reduce your overall cost, and the monthly payments are going to be higher. So you've kind of got to weigh your options. Can you pay a little bit more on the month to have a shorter term? And how much money is that going to save you over the course of that loan? Another type of loan is revolving credit loans. So these are basically like a credit card, or if you have a line of credit, or possibly a home equity loan that's against your home. These carry simple interest. So what that means is the interest is not front loaded on the loan. You pay interest based on how many days you have between making payments. So if you have a loan that's due on the first of the month and you make your payment, come the first of the next month when your payment is due, you're going to pay only 30 days worth of interest onto that loan. These accounts for revolving credit loans, they offer flexibility, but again, if you're only making the minimal payment, it could take longer to pay these loans off. So if at all possible, always try to pay a little bit extra than the minimum payment if you can't afford to pay the revolving loan off on a monthly basis. Here's a repayment example of kind of a payment trap. So if you only make a minimum payment on $5,000 at 15.9% interest, it's going to take you 17 years and 10 months to pay that off, because you're paying not only the monies that you've spent using the credit card, but the interest that's added up over time is $10,658. And that's only making minimum payments. So each payment that you make covers the interest from the last payment that you made. So that interest is constantly adding up, and if you only pay that minimum, it's covering that interest and only a small amount of the principal balance on that loan. That's why it takes so long to get something paid off. So if possible, pay more than the minimum payment. If you can pay twice the minimum payment, that's great, that's better. If anything, though, that you pay over your minimum payment is going to cut down on that interest and help you get out from under that debt faster. So, revolving credit is great. I mean, credit cards are great. We all use them, and, we see that we're going to buy something with it and we have the funds there to do it. But don't use it as a long-term offer, and don't use it as a crutch that, I'll just make a payment and I'm going to buy this now. So here's some pros and cons of installment loans versus revolving credit. So installment loan, the good thing about those is they're for bigger purchases, cars, homes, something you can't pay cash for. You can at times refinance that loan while you have it, and maybe for a better interest rate. So let's say you take out a loan and it's at 8% interest rate. And let's say you pay on that loan for 2 years, and during that time you have not been late on your payment, so your credit score is improving. Maybe the rates have dropped in the economy and it's a lower interest rate now, and maybe you refinance for a 6% or a 5% rate. So that's a good option that you have for installment credit loans. And usually on a installment loan, the rate is going to be lower than a revolving credit loan, and that's because it's secured by collateral, such as a car or a home. Now, the bad thing about that is installment loans are bigger loans. So you're going to have more interest to pay during the loan just because it's a higher balance, which will reduce your debt slower because you have more money going towards the interest of those payments just because it's a larger loan amount. And now let's talk about revolving. So revolving, you have more flexibility. They offer minimum payments. You don't have to pay, the same amount every month. If you have a lower balance, you can pay a lower payment if you want to do so. You can pay those loans in full if you want to. There's some credit cards that may have a cash back or other benefits that would, be beneficial to you. Another thing is that when you pay more than the minimum, then the interest charges decrease right away on a revolving credit loan. So the bad thing about those is kind of like we talked about. It's easy to get into a trap of where I'm just going to swipe this credit card. Your balance keeps getting higher and higher and higher. You're making the minimum payment, and before you know it, now you've maxed that card out and you don't have any more money to use to spend on it because you're only making those minimum payments, and you get caught in the trap of paying on that what seems like forever. So credit reports and scores, they play a huge part in lending and your interest rate that you get on whether or not you even get a loan from an institution. So what's a credit score? So a credit score is a number between 300 and 850, and it is assigned to your credit by the credit bureaus. So there's Equifax, TransUnion, and Experian. Every creditor, every bank, every institution, they all take your loan information and your payment information, and they submit it to credit bureaus on a monthly basis. And once the credit bureau gets that, they just keep adding up the history of your payments, of your loans, what you have done on all of your credit throughout your life, and it's painting basically a picture of your credit worthiness. So, and the credit score that is created from all that information, that's what's used to determine if you are eligible for a loan and what your interest rate is on a loan. So how are credit scores determined? They look at your payment history, the emphasis on the most recent 2 years. So any debts on your credit report, what you've done in the past 2 years, is the most important and the highly factored part of your score. they look at your percentage of available credit. So let's say you've got 3 credit cards, and let's say they all have $1,000 limit, but 2 of the credit cards you don't really use, so you have a zero balance and you still have a $1,000 limit. The other credit card, say it's got a $1,000 limit, but you've got a balance of $800. Well, that's a good thing in terms of credit, because the way that is looked at is you have $3,000 of credit available to you, but you've only used $800 of it because you're only using one card. So that is a way that the credit reports scoring system looks at it and says, okay, they are good at managing their money because they have more credit they could be using and they're not using it. So I would advise that if you've got, let's say you got a couple credit cards open, but there really are a couple you do not use, don't close them, because if you close them, that hurts your credit score. It's better to keep it open and not use it, just leave it as a zero balance, but leave it as an open line of credit on the credit report, because that will lower your credit score. The credit bureaus also look at your length of credit history. So they're, like I said, the most important is the recent 2 years, but the longer you're in the credit bureau system, the more of a picture that you're painting for the creditors. So the more history you have is always going to be the better. And we're looking for like a mix of credit. So we want to see somebody that maybe has a couple credit cards, which is, like we talked about, revolving credit. You've got an installment loan or a secured loan, like a car loan somewhere. You may have a mortgage loan somewhere. And there's also signature loans. We have a signature loan, and it's an installment loan for unsecured money. So it's a fixed payment. It's a fixed term. It's not a line of credit, but you say, let's say you borrow $5,000 and then you pay for 60 months on that $5,000 at whatever the interest rate is. That's called an installment loan as well. So if you have a mix of things on your credit report, then creditors are looking at that, and a mix is better than having just 10 credit cards and no installments or no secured loans. Now, on the credit reports, there are, as I'd mentioned, there's 3 different bureaus, and they're Experian, Equifax, and TransUnion. So the credit union here, we use Equifax. We report anybody that has a loan, their information is submitted to Equifax on a monthly basis to help build your credit history. Now, they do also have information about your personal credit history over the past 7 years or more. So your credit report is always going to have at least 7 years worth of history. Your credit report is going to have your social security number, it's going to have your date of birth, it's going to have a current address and previous address, it's going to have employment history, it's going to have your borrowing and how you repaid those loans, whether you paid them on time. It's going to record if you're 30 days late on a payment, it's going to note that. If you've been 60 days late, it's going to note that. 90 days late, all of that is going to be on your credit report. If you have any criminal issues or tax issues or judgments, collection agencies, anybody placed a lien on, like a tax lien on your property, all of that's going to be on your credit report. If you left an institution where you had a checking account and you left owing them money, that can be reported to your credit report. So all of that stuff can be on your credit report, and anything that's derogatory is going to drag your credit score down. And you don't want that, because this credit score is so important in being able to get a good interest rate on a loan, and also whether you will be approved for a loan or not. So how do credit reports used? They are used in all kinds of ways. Now here at the credit union, the way we use them is to determine if you qualify for a loan or not. But landlords, so if you're renting somewhere, landlords will, some of them look at your credit report to see how you've paid your other debts, so they know whether or not you're going to be a good candidate to pay rent. Employers can look at your credit report. We are in a financial institution, so we're going to look at a credit report of a potential employee to see if they can manage their money, because they're going to be working in a setting of finances and money on a member's accounts. Insurance companies look at it, and they look at it to basically quote you a rate, and they're probably looking at it to see on vehicle loans, have you had car loans in the past where they charged off? Are you making payments on your car loans? Are you just making payments in general so they know whether or not they're going to do an insurance policy for you, especially if you do a policy where you don't pay in full and you're going to be making monthly payments on it. So the credit report that has a lot of missed payments, a lot of collections, it's really just painting a picture of how you handle your finances. And so when you have that, or you have someone looking at your credit, you want them to look at it and see that you take care of your debts. If you borrow money, you pay who you borrowed because you owe them that money, and you're a responsible adult and you're going to take care of those things. So if you want to get a copy of your credit report, you can get a free copy every year if you go to annualcreditreport.com. Now, they don't have a credit score on those, but you can at least get your credit report and you can look at it and see if are all the debts on there, are they yours? Did anybody by any chance open a loan in your name? And if they did, then you need to take the steps, to fix that, to take care of that issue. So reviewing that report and making sure that information is correct is one way to protect your credit history and to protect just your credit profile. And there may be on there, let's say you mailed a payment in on your car loan, but you get that credit report and it says you've missed a payment. Well, you haven't missed any payments. That's going to clue you in to get a hold of where your car loan is financed at and ask them to research to see what's going on, because institutions can make mistakes. They could have possibly applied it to the wrong person's loan and then you didn't get credit for it. So make sure you're, kind of checking that credit report at least once a year, but also check those bank statements to make sure that when you mail in a payment, it's applied to your loan correctly. If there's something on your credit report that you feels wrong, you're like, no, that's not me, I didn't do this. You can dispute that, and you do that by contacting the credit bureau directly. And what they do is reach out to the lender, and they send them a report saying, Mr. So-and-so says that this is not their data, they're not late, whatever it might be. And then that institution has to respond back to the credit bureau. So they have to look up the information and verify if they have something incorrect or if they have something that's correct, and then they report it back to the credit bureau. And if it's something that needs to be taken off your credit report, at that time the credit bureau will do that and take care of it for you. Now, if you get your credit report and you see it's not your correct address, not really a big deal. Those get updated, over time, but really you want to look at the loans, you want to look at the payment history, you want to make sure they are your loans that you have on there, and your Social Security number. Make sure that is not incorrect at all. Now, if you see it, we talked about if you see something you don't recognize on that credit report, call the institution right away. File a dispute with the credit bureaus. Make sure that you're taking steps and don't just ignore it and not look at it. You can also put a freeze on your credit report, and you do that by going onto the website for TransUnion, Equifax, or Experian. You can create an account, and then you can actually put a freeze to where no one can pull your credit. And so that protects, let's say someone got your Social Security number and they tried to apply for a loan in your name. That freeze will keep them from being able to do that, because that merchant won't be able to pull your credit. And so if they can't pull credit on someone, they really won't be wanting to approve a loan for them because they can't verify the credit. So that's a good way just to kind of protect yourself. Now, I can tell you one of the things that happens if you do that is if you're out somewhere at a store, and let's say they're giving 25% off if you open a Kohl's card, if you've put a freeze on your credit report and you're at the checkout line and Kohl's trying to run your credit to see if they can approve you for a Kohl's credit card, it's not going to work because they're not going to be able to see your credit either. So at that point, the cashier at Kohl's is going to say, I'm sorry, I can't run your credit right now, and they're not going to be able to give you a card at the teller line. What you would have to do is log into that credit bureau, whichever one they use, or maybe all three, turn your freeze off for a temporary time. Then they could run that, and then you could put it back on. So it's kind of a hassle, but it protects you in the long run if someone is really trying to steal your credit or take out a big loan in your name, and you will know about that. So building and maintaining credit, that's something that's kind of a lifelong goal for everyone, and it takes a long time to build your credit. So when you establish credit, you can't even start till you're 18 years old. So once you're 18, you can legally go into a binding contract and you would open a credit account. A lot of young folks will maybe do a $200 or $300 credit card, and that will get them started on their very first piece of credit for the credit bureau. Most of the time, somebody that's 18 is going to have mom or dad co-sign because they don't have any credit history, and lenders are going to want some kind of assurance that this young person is going to pay this debt, because like I said, they have no credit history, so there's nothing to look at and see if 18-year-old Marianne has paid debt. So typically, mom or dad is going to have to co-sign with them. When that happens, the institution is going to look at mom and dad's credit. Has mom and dad paid their bills, throughout their life, or has mom and dad not paid anything? Do they have a bunch of credit cards or car loans or things that's been charged off or repossessed? And if they do, then they're not going to be a good co-signer for little junior who's wanting to get a loan. So paying the bills on time is absolutely what you have to do, so that way on your credit report they are shown as current, and it keeps your score higher. And we talked a little bit before about minimizing the available credit used. So if you've got 3 credit cards, all with $1,000 limit, 2 of them is a zero balance, and 1 of them you owe $800 on, try to only use that one and pay it down as much as you can every month, so that you don't max it out and then start using the other 2, because now you're limiting the credit that you do have, and that hurts you on a credit score. So when you are choosing a credit card, look for certain things. Look for a fixed rate with no annual fee. So our credit card here at Beacon starts at 8.99%. It's a fixed rate, and guess what? No annual fee. We don't have any of the rewards and the perks and all of those things that some cards do, but cards that typically offer that are having interest rates of 17 to 28%. So what we do is we just have a flat 8.99%. It's what it starts at. And again, that's going to be based on your credit score. But we try to keep just a no bells and no whistles card, just to keep something with a low interest rate. Now, some cards, if you're looking out in the market, they may have free credit monitoring. So that is something that if you're looking for a card that's not here with Beacon, then you can look into see what kind of perks they offer. But watch out for an annual fee. Some credit cards can charge anywhere from $59 to $199 a year on an annual fee. You don't want to do that. And that's just some of the things just to kind of keep an eye for. Make sure it's a fixed rate, because if it's a variable rate, they can change that rate on you at any time also. So spending with credit also involves a risk of late payments. If you're late on your payments, that's going to damage your credit. So start with just a small credit limit if you're new to getting credit cards, and learn how to manage your payments, and making sure that you're budgeting so that you've got money to make that payment every month, or even pay a little extra. So when we talk about managing your credit, we also want to talk about, like on those credit card statements, when you get it in the mail, look at it. Make sure there's not a charge on there that you didn't do. Make sure your payment was applied to it. Make sure everything is correct. So there is a required minimum payment every month to make on a credit card. If you can pay that balance off in full every month, then you would pay 0 interest on it. You only start paying interest on a credit card when you have a balance that rolls over from month to month. So if it's at all possible, pay it off in full. A lot of times it's not possible, and I get that. So then you want to make over the minimum payment if you can. Even a little bit over is going to be better than just making the minimum payment. And if you're having trouble with your payments, maybe you've got something going on with your job, an emergency, something's happening, reach out to the creditor and talk to them. If you get a phone call and it's from the financial recovery person at an institution, don't ignore the phone call. Just call them back and, be honest with them and tell them what's going on. Whether it's, hey, I lost my job and I can't afford to make this payment. whether, I've been out work sick for 3 weeks, I'm going back on certain time, just stay in contact with them. They can't waive the debt at all, but they can give you a little bit of a leniency or more time to make your payment. But it's so important just to be in contact with the financial recovery department if there's something going on and you're not able to make your payments on time. So building your credit, it's not a short process. It's a long-term project. And the biggest things that you've got to remember is always pay your bills on time. That's the biggest thing that's going to give you a better credit score. Try to use 30% or less of the available credit that's on your credit report. That way you still have extra credit available, which helps your score. And if you did have an emergency, you haven't maxed out your credit cards on things that maybe you didn't really have to have right there or didn't want, and they're all tempting. You got that card in your purse or your wallet and you're in the store and you're like, oh man, I'll just put it on my credit card and then I'll pay it back. And if you do that just every once in a while, no problem. But if you find yourself going shopping every week and every time you're there, you're like, yeah, I don't have the money for this, but I'm gonna put it on the credit card. That's gonna get you in a little bit of trouble. So most people really don't need more than one credit card to use, but it's nice to have another credit card or two that has a zero balance like we talked about and has a limit, just so you've got that to help increase your credit score. Whenever you apply for any type of loan of any kind, credit card, car loan, whatever it might be, that's going to affect your credit score and it's going to reduce your credit score. So it's a hit on your credit score. It's not a ton, not a big drop, but it's still going to reduce it a little bit. And again, if you're having trouble making payments, always, always, always stay in communication with the lender. Like I said, they can't waive the debt, but as long as you're in communication and talking and working, you all can work together to get a resolve and get to a better end game. So as far as today's workshop summary, it was all just about credit, what type of loans there are, making sure that your credit stays current because it's so important. And, the longer term you have on a loan, the more money you're going to pay back in interest. So it's going to cost you more. So when you're looking at those loans and they're giving you payment options, if payment number 1 is really high, you just can't do it. Payment number 2, yeah, you could swing that. Payment number 3, ooh, that's cheap. Go for payment number 2. Do yourself a favor and then pay a little bit more each month so that you can pay that loan off faster and save yourself money on that interest. We saw in that first example, interest went from $9,000 on a 5-year loan to $42,000 on the longer 20-year loan. Don't get yourself hooked in a situation where you're paying forever on something. Credit reports and scores, they're used more for just your loan applications. Employers look at them. Landlords look at them. When you're buying car insurance, they look at your score. Check that credit report at least once a year. Do your free credit report because identity theft is serious. Make sure nobody's opening a loan in your name or opening an account in your name. Remember that you can put a freeze on your credit report so that no one can do that. And if you do that, it's also going to affect you if you're standing in Kohl's line wanting to apply for a Kohl's card. They're not going to be able to get your score either and not approve you right there in the line while you wait. So building and maintaining your credit is so important. Paying your bills consistently, making sure that they're paid on time, working with any institutions if you're having problems. Those are major factors in your credit score. And I'll tell you just what we do at Beacon when we're looking to approve someone for a loan. So if you come in and you need to borrow $1,000, let's say for example, we take your pay stubs and we see how much money you make, how much gross money you make on a month, and then that's on one side. On the other column, we take all of the debts that you owe. So we'll take your rent or mortgage, any car payments, any credit card payments, any other loan payment that you have, and we'll total that in a second column. And then all we do is divide your debts plus the new payment amount for the new loan you're wanting into your gross pay. And we're wanting to get you somewhere 40% or less is what that percentage should be. And now remember, I said your gross pay. So out of your gross pay, there are no taxes out of it. It's not accounting for the gas that you have to pay for your car. It's not accounting for the food and groceries that you buy for your family. It's not accounting for you're going shopping and spending money. We're using your gross pay. So whenever you apply for a loan and someone tells you, this is what your payment is, then in your mind, you know what your other bills are. So you make sure you can afford that. And I know sometimes people go and they get, pre-approved for a home loan, and they'll tell them, oh, you can afford a $600,000 home and your payment's going to be, $2,000 a month. Well, on paper, maybe you can afford that because they're taking your gross income. But really think about that. If you had to pay $2,000 a month for this mortgage that they're saying you're pre-approved for, take that and calculate it. Write down your $2,000 mortgage. Write down all your other bills. Write down your utilities and your gas payment and your groceries payment and your spending fund money, and see, can you really afford that in real life? Because sometimes on paper you can afford something, but when you write it down on paper and or start doing your own calculations, you're like, well, $2,000 for a mortgage, that's a lot, because I got to pay $300 a week for groceries. I've got to put $100 a week of gas in the car, and then the kids need clothes. So just really look at stuff, look it over when you're applying for a loan and somebody tells you what the payment is, and just do whatever's best for you that you can afford, because you don't want to get yourself in financial trouble. I hope this was helpful. I'd love to do it in person, because that way we could get some questions and answers. I am going to be at Fairdale to do a sit down and talk with any of the parents that can make it to the next event. But if you have any questions about credit or loans, I know this was super fast and a very short overview of everything. Just come down to Beacon Community Credit Union at 7910 National Turnpike. We've got a whole loan department, and they can sit down, they can go over everything one-on-one with you if you apply for a loan. And there's questions on the credit report, they can actually sit down and address it with you individually. If you get your free annual creditreport.com and you're a member, you want to bring it in and just say, hey, what is this? What is this telling me? Then our loan department can also help you with that. So anyway, I hope this was helpful, and I look forward to talking to you next month, and we are going to do budgets. Thanks. Bye.